Hi, it's Mikey. I'm here to introduce you OnX Finance. As Ethereum is looking to break all-time high, most altcoins have been getting attention, and I heard about OnX Finance during an airdrop for ankrETH holders. I started using OnX Finance one day after its launch of December 21st, 2020, as the bonus rewards for yield farming were very attractive, and the expected pace and amount of new release looked very promising. Indeed, OnX Finance aims to be the first hub for collateralized tokens. I also identified from the roadmap and asset incorporated on the platform that one of the first problems that it was aiming to solve was the AETH price discount versus ETH, which was trading at a 50% discount in average during the month of January 2021. Indeed, how could you be a hub for collateralized tokens without helping people understand the true and fair value of the first synthetic internet bond based on stake Ethereum? One of the upcoming products, lending, is aiming to provide tools to AETH investors to exploit the market inefficiencies related to AETH price, which should bring it closer to fair value. 1 ETH plus ETH accrued staking rewards, automated asset manager, and other products expected by end of February or March 2021 will provide more tools to AETH investors willing to simplify their trading arbitrage strategies and enable automation of arbitrage opportunities between AETH and ETH. Products 1. Lending. The first use case presented for the upcoming lending functionality will be to borrow ETH up to 75% using AETH as a collateral, and the lending ratio should stay below 90%. But why would you do that? AETH lending value will be based on its fair value, not market value, as the fair value of AETH is ETH plus ETH accrued staking rewards is equal to 1.005 ETH as the time of I'm recording this video, but the market value of AETH is approximately 0.95 ETH. Buying AETH at a discount for patient investors trusting the ankrETH will enable AETH investors to pay back stake ETH at phase 1.5 of ETH. 2 is a financial decision that would make a lot of sense. But what if you could leverage those AETH price discount, currently approx 5% discount, leverage the future ETH staking rewards embedded in AETH, leverage OnX rewards for staking AETH on OnX platform, 55% APY at the moment, but avoid leverage ETH market risk. But how many times can I perform this loop? Indeed, as you borrow ETH using AETH as a collateral to buy more AETH, your collateral is increasing if you stake those new AETH on OnX platform. As such, you could perform this loop a second, third, fourth, and several times until the new collateral obtained from borrowing become too low to compensate for the ETH gas fees. According to my estimation, approx 3x leverage is possible for the several initial AETH amounts that I simulated from 10 AETH to 100 AETH. As such, for anyone considering staking ETH and not much concerned about ankrETH and OnX platform risk, using lending on OnX is amazing solution to participate in the price stability of AETH, exploit its arbitrage opportunities, and obtain a far more superior return on ETH without leveraging its market risk. Will it still be an interesting product when OnX rewards APY for staking AETH will be lower? Staking ETH, which is necessary to obtain ETH for borrowing, and it will be rewarded 7x farming pool at launch, or AETH are not the only ways to generate passive income with ETH. Indeed, you can also provide liquidity to Uniswap or Sushiswap, AETH, ETH liquidity pools, LP, and we can expect LPs to be used as collateral in a near future after OnX lending launch. AETH, ETH, LP, Uniswap, APY is 30%. When ONX reaches that milestone, not much will separate ONX than Alpha Homura deposit. The fact that ONX will likely continue to focus on ETH related assets and any other internet bond that ANKR might launch in the future. 2. Collateralized token swap (CTS). As investors will have several collateral assets, internet bonds, LPS available to stake on ONX platform and might want to change their collateral. Collateralized token swap is a very important feature to avoid several operations that would trigger several ETH gas fees, payback loan, release collateral, trade on Uniswap, deposit again new collateral, and request the initial loan amount again. By offering CTS on the platform, ONX platform can charge CTS fees and will distribute it to ONX holders, increasing the utility of the native token of the ONX platform. This feature should be expected in the second half of February 2021, after landing and before automated asset manager. According to the snapshot taken from the Unsynthetic Medium article, we can also see that the stable coins USDC, DAI, and FRAX will likely also be introduced on the platform at some point. 3. Automated Asset Management (AAM). At the moment, there is not much information available about this upcoming product. However, we can deduce that the more assets will be available on ONX platform, the more strategies will be available as AAM. For instance, it is possible to create a 3x long AETH, 2x short ETH loan strategy thanks to lending. It would be possible also to facilitate investing in AETH, ETH liquidity pools through AAM by enabling leverage and contribute to the strategy with only one token pair instead of both. For example, 10 AETH contribute AAM will borrow the same amount in ETH to apply the 2x AETH ETH LP strategy. A similar approach would also be possible with ONE ETH LP as well as ONS ETH LP. Pure leverage strategy by borrowing USDC or DAI would likely also be possible within AAM. I would also suspect that the team would consider WBTC to collateralize it for lending, which would enable other possibilities such as creating a 32 ETH WBTC index strategy, for instance. Ultimately, AAM will be very important to automate several potential building blocks of crypto diversified portfolios. Last but not least, AAM will generate fees which will likely to be distributed to ONX holders like V2 Volts on OnX Finance that generate a 2% management fee on asset under management AUM and 20% performance fee. 4. Insurance. There is no information about this product at the moment given the very ambitious roadmap ahead, but we can expect this offering to be similar to Cover, which recently merged with OnX Finance. Product refers as Insure on OnX Finance. The utility of insurance under OnX Finance is the following: vaults that hold assets that are used to provide payment in the event of a claim. Vaults that hold assets that the holder desires to be covered. Claim governance, which represents the claim arbitration process. 5. Governance. Governance will be one of the last pieces of ONX token utility. We can expect that a DAO will be founded at a later stage and token holders will likely be able to propose improvements subject to a voting process in a similar way than other governance tokens of other DeFi platforms. 6. Non-fungible tokens. After exchanging some messages in the ONX Telegram group and Mike, OnX Finance's point man, I understood that the usage of NFTs is being considered. However, I will refrain myself of speculating about any future potential usage of NFTs given the lack of provided information on this topic. There are certainly many possibilities that could be applied on ONX platform using NFTs and positive surprise might come in the future related to this topic. Token utility. ONX token expected utility is the following. 1. Pay reward to ANKR, AETH, ETH, ONX LP and ONX stakers. 2. Pay interest for ONX lending. 3. Decreasing supply mechanism. 1/3 of lending interest paid to lenders will be burnt or bought back by ONX, accepted on February 2021. 4. Receive discount on the ONX platform. 5. Receive a portfolio of trading fees from the expected collateralized token swap or CTS. 6. Governance. 7. More benefits as service and products are added to the platform are open for consideration. Tokenomics. OnX Finance has what we can call a fair launch with only 1% of the total supply time lock for the team and more than 86% is distributed through the community through yield farming. The token distribution through yield farming is also very transparent and predictable, as all tokens are expected to be farmed by December 2021. Comparative analysis. To estimate the fair value of ONX when compared to other projects, we need to look at the following metrics. Total value locked TVL, market cap TVL multiple, months since token launch, circulating supply and total supply, percentages of non-circulating supply, largest wallet or group of closely linked largest wallets as a percentages of total supply. We can observe from the comparative analysis that ONX benefits from low TVL when compared to its competitors, lowest market cap, youngest project, non-circulating supply has been decreasing very fast in comparison of the months since token launch, thanks to the fair token distribution mechanism that will end on December 2021. Benefits from a very low concentration of large wallets. I am as well very surprised by the level of token concentration of large wallets in comparable projects, as it removes from the circulating supply a large portion of the assets that can only lead to an increase in prices given the very thin real supply available on the market. Concentration of large wallets can be a problem for the following reasons. Governance tokens with a large wallet concentration should undermine the governance value of the token. During altcoin seasons, these tokens are likely to fall faster as large wallets are more likely to cash in their gains. Concerns about OnX Finance. The OnX team is semi-anon, which could be perceived as an issue for some investors, including myself. As such, I observed the Telegram group and was very surprised that the team manager himself, Mike, was intervening himself in the chat to reply the most tricky question and provide regular updates about the project development. I also witnessed a very dedicated community in the OnX Finance and OnX Trading Telegram group, where several members provide educational content to accompany new users interested in OnX and teach them the basics of yield farming, while remaining careful about communicating fairly the risks involved. Anonymity versus transparency. Are those concepts compatible? Bitcoin itself is a prime example of that, and it remains to see how governance will be enabled to ONX holders over the several months. But for the moment, I think that it is still essential to have someone leading ONX platform so that it can implement its roadmap quickly in a fast-paced DeFi environment. The team token allocation 1% of total supply and size of the largest wallet 1.4% of total supply are reassuring in my opinion to outweigh the team anonymity feature of OnX Finance. I believe that governance and the transparent decision process that will come with it will likely remove any remaining discomfort related to the team's anonymity in the future. Conclusion. To conclude, I feel very lucky to have found OnX Finance very early, as it incentivized me to try and learn yield farming. The fair token distribution makes this project an exception rather than the norm in the paradoxical concentrated current DeFi landscape, likely to get more concentrated with the merger and partnership of Finance with other DeFi projects. In the current negative zero yield environment where it is becoming extremely difficult to generate passive income in Main Street, collateralized assets represented mainly by liquidity pools and internet bonds offer promising prospects of superior passive income thanks to lending, automated asset management, and insurance. This new emerging asset class will certainly grow over the next few months as a diversifier in the volatile crypto market, and in my opinion, OnX Finance will certainly capture a fair market share of this new market.